battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office for the past 43 years. It's been our mission to deliver both clarity and confidence to help secure your financial future. We got episode 150 coming to you live. We have producer Owen in the producer seat. Welcome back. We had Martin Norton, CIO of the Americas for Morningstar Investment Management on Bullish. Go watch it. Huge podcast. Big time guest, Martin Norton, CIO of Morningstar. Go check it out. It's on YouTube, Spotify, and Apple. If you're watching this show, go subscribe, YouTube, Spotify, and Apple. It helps us get it to a bigger and bigger audience so that we can get you the clarity and confidence. We can get your friends the clarity and confidence and your families, because we know there's a correction coming down the road later this year. And if the S&P is down 10%, remember what people do. They will panic. And so that's why we would encourage you, get the content, get the good news to them so that they can hold on to their plan when the times get tough. Well, we have a big time show for you today. We're going to cover Berkshire's 2024 annual meeting. That's the title and episode of the article, Berkshire's 2024 annual meeting. But I do want to just point out the fact that we have been spot on giving you tomorrow's news today, trying to point out that earnings were not going to be the bloodbath that people thought. Yes, the Fed is uncertain. Yes, Jerome Powell has no idea what's going on. Doesn't know where interest rates are going, doesn't know where inflation is. You can't blame them because it's Marxism. It's the Fed, central planning, monetary policy. When you have all the control in one small group of people, obviously they don't know what's going on. The economy is way too intricate, way too complex for one person to plan, so you can't really blame Powell. You have to blame the people that set him up for failure, which are the politicians on both sides of the political aisle, whether it's Republicans or Democrats. They are saying, hey, we don't want to raise taxes. We don't want to have to cut spending or social programs. Mr. Powell, can you please print us the money? And then he gets the Fed's printing and press out and chug, chug, chug. Next thing you know, we have 45% more dollars in the economy than we had 4 years ago. And you're thinking to yourself, wow, everything costs 45% more. No, no, no. As Brian Westbury from First Trust Portfolios has consistently pointed out, it's not that stuff costs more. It's that your dollar buys less stuff. Very important to understand. So that's the bad news. That's the kind of crazy stuff going on that's impacting valuations on a short-term basis. But the good news is earnings are blooming. And that's from Ed Yardeni, Yardeni Research. Just saw him on CNBC. He's coming to Investor Day. I'm happy to finally announce Ed Yardeni is our keynote speaker. Fantastic. Absolutely unbelievable. He's been even more bullish than us, which is hard to believe. We've been pretty bullish here on the Nick Stenger Show and at the Stenger Family Office. Ed Yardeni, even more bullish than we are, and he's been right. Earnings are blooming. This is from his morning briefing, May 7th. And he's talking about how earnings are really driving the market higher. It's not just 7 stocks. We're getting a broadening out of earnings across different sectors, not just technology, not just the Mag 7, but we're getting widening of where the profits are coming from, and that is a bullish sign for markets. And Dr. Yardeni says markets are not radically overvalued. We've said that too. Maybe fairly valued, not radically undervalued like we had last fall or the fall before it, but fairly valued nonetheless. That does not mean that the sky is falling. We could have a correction, but companies are not falling apart. You should be an optimist, just like Warren Buffett, which we will get to in one second. And I do want to point out FactSet. Some interesting stats here. Pay attention to these numbers. These are really important. This came out last Friday. 78% of S&P 500 companies have reported a positive earnings surprise. They've surprised the street. 78% of them. That's big. We're seeing 5.4% earnings growth on the S&P 500. That's big earnings growth. The forward 12-month price to earnings ratio on the S&P is 20.4. Slightly above the 5-year average, slightly above the 10-year. Stocks are fairly valued. That's number one. Now, here's what's really interesting. If we take out one stock from the earnings mix, we take out Bristol-Myers Squibb, the pharmaceutical company, the S&P 500 would be reporting earnings growth not at 5.4%, but above 8% for the first quarter, just taking out one quarter of bad earnings for Bristol-Myers Squibb. Pretty big deal. Now, let's go one step further. Let's take out Bristol Myers. Let's take out Gilead. Let's take out Pfizer. Earnings growth on the S&P for the first quarter without those three companies included would be 9.7%. Unbelievable. It's insane. I mean, that is fantastic earnings growth. It's not seven stocks. That narrative is wrong. So be careful of who you listen to. Be careful of the narrative that you're exposing yourself to. You got to get the facts. You got to get the data. You got to get the information. You got to print out the articles. Now, somebody did leave the cardstock in the printer, so I've got it printed out in cardstock. That's okay. We have the data, though. We have the documents. We have the information. You got to get your hands on the documents. You can't just listen to narrative. Now, if we go a little bit further into the weeds here on FactSet before we get into this week's article, you'll find out that the percentage of companies beating EPS estimates, remember 78% of S&P 500 companies now are beating analyst estimates for the first quarter, is above the 5-year average. So why are stocks up? Why are companies valued where they are today? Why is the S&P at 5,200 points? Why is the Dow approaching 40,000? Because companies are doing well. So don't buy this narrative that the world is falling, that only 7 companies are driving the market and everything else is falling apart. It's just not based in reality. It's not based in the data. All right, we'll wrap up with one last point from FactSet's weekly piece here. Financials have seen the largest increase in revenue since March 31st. Going a little further, communication services, Google and Meta are leading year-over-year growth. The growth rate in communication services, the earnings growth rate, has been 34.1%. Oh, wow. Unbelievable. Google earned 1.89 in earnings versus 1.17 last year. Meta earned almost double what it earned last year. Why? Because they realized the metaverse, nobody really wants to be in the metaverse. Sorry. So we're pivoting. We're going towards common sense. They fired a bunch of people from the metaverse. Not saying firing people is good, but we did have a bloated payroll at some of these big tech companies. We had people in charge of goat yoga. We had people in charge of, smoothies. Okay. It turns out we don't need 15,000 people doing nothing at these companies, and earnings are going up. Utilities, electric utilities was the largest contributor to S&P earnings, growth of 33.4%. Consumer discretionary, Amazon is the biggest contributor to consumer discretionary profits year-over-year growth. Unbelievable. If you've never just sat there and been dumbfounded by Amazon like I have been amazed, been just totally astounded by how Amazon works. I mean, literally last night I was going through my bathroom supplies. I realized I am running out of razors and I don't have time to go to the store. So I punched up Amazon.com on my cell phone. I punched in razors, and literally this morning I wake up and the razors are at the front door. That is pretty unbelievable. I mean, if you're not amazed by that, you really need to be amazed by it. It's incredible. So that's the kind of technology we have today. Of course, in the IT sector, NVIDIA has been the largest contributor to year-over-year growth with the AI craze. Maybe some of it's overdone, but that's okay. NVIDIA is making money from it nonetheless. None of this is investment advice, but I'm just trying to point out to you that things are good underneath the surface for a lot of these big companies. Now, things are not good for every company. And I've said this, watch out for international. Watch out for China. China has been a disaster. Watch out for small caps and mid caps. The small caps and mid caps that used to borrow money at 5% 3 or 4 years ago are now borrowing at 12, 13, 14, 15%. That is a big, big problem. We're also seeing Japan have a decent enough year. But if you take the currency out of Japan, the currency hedge, Japan's really not doing anything. So be careful, again, with who you're listening to. I have told you to focus on the big companies, the top 50, and it's not that the top 50 are going to completely insulate you in a downturn. That's not the point. But the top 50, my opinion, in the U.S. will have better balance sheets. The S&P is a meritocracy. The biggest rise to the top, the biggest get bigger. The small ones get kicked out and go to zero. That's why we focus on the top 50. All right, let's stop right there. Let's talk about one of the top 50 for the rest of this week's show, which is Berkshire Hathaway. They just had their 2024 annual meeting a few weeks ago. Warren Buffett's first speech, first meeting since Charlie Munger died. Very sad. Obviously, these two guys were best friends, business colleagues, and really important to understand how Charlie Munger, who just passed away not too long ago, influenced Berkshire Hathaway, influenced Warren Buffett. Remember, Warren Buffett grew up in the Benjamin Graham methodology of value investing. And there's a great book, The Intelligent Investor. If you haven't read it, you should go read it and get your hands on it. It's a fantastic book. It's a classic. And Benjamin Graham happened to be Warren Buffett's mentor. He said you should buy companies that are really cheap and kind of left it at that. And so Warren Buffett started buying companies that were really cheap. It was called the cigar butt methodology. You'd find a company that basically was like a butt of a cigar on the ground, had maybe one last puff in it before you'd completely toss it out. And that's what Berkshire was buying in the beginning, was these cigar butt companies. Worked out okay, had some losses, but for the most part, it wasn't bad. There was some earnings growth there. Finally, when Buffett met Charlie Munger said, listen, Warren, I want you to throw out everything you learned from your former mentor, Benjamin Graham. Forget everything you learned from Intelligent Investor, and I want you to buy great companies for a fair price rather than fair companies for a wonderful price. And that's when Warren Buffett really turned the corner. He had some bumps and bruises along the way. He had revisited some of his old habits, as he writes about in his shareholder letter from last year. And Charlie Munger brought him back to the middle and said, hey, buy good companies. If you pay a little more than you would have liked for them, that's okay. They're great companies. And without Munger, Warren would have never bought Coca-Cola. He would have never bought American Express. And he also never would have bought a little company known as Apple, because Apple has always traded at a large multiple for the most part. There was some time in the past where Apple traded for 10, 11, 12 times earnings. And I hope you bought some back then like we did, because that was a wonderful buying opportunity. But the point is when you find a good company, you gotta be willing to pay a little bit more for the earnings. Now, should you pay 200 times earnings? Of course not. And Warren's been phenomenal at this, is pointing out the times where things are not a good investment, when things are dramatically overvalued and don't make any sense. And that's where we have our job is to go out and find companies that aren't radically overvalued. Now, maybe we're paying 25 times earnings for a fantastic company, but some other company, a value stock, might trade for 10 times earnings or 12 times. You can't just compare those price to earnings ratios in a vacuum and say one is overvalued or undervalued, because a lot of companies, as we'll find out, are actually cheap for a reason. And that's been the secret of Berkshire Hathaway, is to try and find companies that are relatively inexpensive, that are well-priced, great companies, but then not get into value traps. And so that's why when you're doing dividend investing, you got to be careful before you just sort for the highest dividend payers, because there's a reason why a company pays a high dividend. And typically it's because their stock price might have gotten cut in half or by a third or even worse. And that's probably why their dividend's so high. No company is actively trying to pay more than the market rate in dividends, maybe 2, 3, 4% at most. And sometimes a high dividend payer alone is not always a good investment. And that's why we've focused on dividend growth, companies that are growing their dividends, that have a potential to keep growing over the long run. That's why we put those screens on earnings. So anyways, couple of lessons from Berkshire Hathaway's annual meeting from Warren Buffett and Charlie Munger. I'll cover a few. There's probably 20, and you can read about them. We have the book on the bookshelf behind us here, The Essays of Warren Buffett. I encourage you to get that book as well. Phenomenal. Really help you understand how companies operate. But let's just cover a couple on today's show. Number one, cash is king. At the end of the first quarter, Berkshire reported over $182 billion with a B in cash and equivalents on its balance sheet. In one quarter alone, Berkshire earned $4.3 billion in dividend and interest income alone. Companies like Berkshire and Apple and a number of other companies with large war chests of cash are literally earning more on that cash today than a lot of mid and small cap companies make in revenue and, of course, in profits. Unbelievable. Berkshire has a fortress balance sheet. It's been used, a term that's been used to describe their cash position. Now, Berkshire is not going to be insulated from a recession, much like the top 50 strategy that we use. But careful risk management and advanced planning has helped protect investors through complete economic cycles. Now, there is a point where too much cash is actually a drag. Berkshire has admitted to this. Warren Buffett has admitted to this. Hey, we may have too much cash. He wrote in the last shareholder letter, we've got so much cash, it doesn't even make sense. Okay, he said that in the last shareholder meeting on the last article that he wrote. So at some point you may have too much sitting there, but it's not a bad thing. You can't get hurt by having too much cash on your balance sheet. That's why we encourage clients to remain positioned towards high quality large cap companies that have the ability to weather the storm when, not if it occurs. We know there's a correction coming. It's the matter of when, not if. But the one thing you have to be a little bit careful of is inflation. And so that's what some people have gotten a little bit frustrated with Berkshire on is, hey, there's been opportunities. Why aren't we in some of these opportunities? And it's not like Warren's been perfect. Warren has missed the boat from time to time. He admitted that he missed the Amazon boat. He missed a couple of these big waves in commerce and changes in how people buy things. And he wishes he would have bought Amazon, for example. So he may be sitting on too much cash, but he is getting 5.5% risk-free. Lesson for retirees that we use in our portfolios is go to a goals-based financial plan. You don't want to have a risk-based plan. And this is where people really can go wrong. They listen to the doom and gloomers. They listen to the narrative and all these people saying the sky is falling, and they'll go into a 60-40 portfolio, 60% stocks, 40% bonds. Well, here's the problem with the 60-40 portfolio for most people, not for everybody, but for most people. It's got way too much in an asset class, bonds, that are not going to beat the rising cost of goods and services over the long run. And so the 60-40, when we were in this bond bull market, remember rates were 19% in the 80s. Now they're up a little bit, but they're still nowhere close to 19%. Up until this year when rates went up, and last year, we were in this massive bond bull market. So that 60-40 was fantastic. You were getting 6-7% on your bond returns. You were getting 8-9% on your stock returns. Well, a lot of that now I think is changing. And let's just say we do go into a world of higher for longer, which I think we're going to be in, maybe not forever, but for a while. And let's say inflation is persistent. Let's say that we do not get costs down as fast as people think, as fast as the experts say. Remember the so-called experts who called inflation transitory just a few years ago. And let's say they're wrong again, which I think they will be, and rates stay higher for longer. I think you have to be very careful with having too much exposed to especially long-term bonds, but the bond market in general, because the bond market is not going to save you in a high inflation environment. Okay. And I wouldn't go as far to say this yet, but I think it's very possible that we could go into a extended bond bear market. And that's what we had leading up to the 80s. We had a bond bear market. And I think we could have a bond bear market. It won't last for 40 years. I don't think at least, but it may last a few years. And that's why I say be in equities. Equities, which are more volatile, have the power of beating inflation because companies raise their prices in real time to react to higher prices. So that's why you have to be in the equity market. Now, what's the price you have to pay to be in equities? It's volatility. It's the ups and downs, the wild swings of the market. It's the COVID crashes, 08 and 09, 1999 with the tech bubble, 1987, Black Monday. It's all of these big doom and gloom stories that threaten your ability to stay on your plan, but don't necessarily threaten the viability of the companies you own. So be careful understanding and distinguishing between risk and volatility. There's a difference between stocks going up and down and true risk, which is defined as running out of money in retirement because you can't keep up with inflation. So big difference. That's why we've said do a goals-based plan, not a risk-based financial plan. Don't start. It's not a bad question to ask, but you don't want to start from the standpoint of, hey, what's your risk tolerance? Are you a 5 out of 10, a 6 out of 10? How much are you willing to lose in a market decline? And by the way, those things are all behavioral anyways. They've done studies on this, and they ask people, hey, how do you feel about risk? And when times are great, what do people say? Oh, I feel great about risk. Let's take on tons of risk. I love being in equities. It's fantastic. Then the market goes down, stocks are in a bear market, and they ask the same question, how do you feel about risk? What do people say? Oh, I hate risk. I don't want any risk. I want to be safe. So you can't go off of a risk questionnaire as your number one question and your starting point. You got to go off of a goals-based plan. What do you need to hit your objectives? If you're going to try and make it 30 years in retirement, okay, let's say you start at 60 and you want to live till 90 or 92 or 95, or at least plan for that, then you better make sure you've got enough in equities to get you where you want to go. But what we do is at the same time have 3 to 5 years of living expenses in something that's very high quality, very short term, that you're not going to get wiped out on when there's volatility in stocks. Martin Norton pointed this out the other week. She said, look, it's been very difficult to own short duration, especially when rates were 0% for the past couple of years. But see, that disciplined approach that we've had in our client portfolios by being short duration has really helped you out if you've been our client. Why? Because we haven't taken risk in the bond market. We've taken our risk in the stock market, and we've looked at the treasuries. Maybe you have an 80-20 portfolio, that 20% as your safe money. Okay, so that's number one. Cash is king. Be careful with what you're doing with the cash. Don't take risk with it. Number two, invest in what you know. Assuming a company meets a variety of quality screens, the Berkshire approach to investing has been investing in businesses that anyone can understand. Further, Berkshire has invested in companies that might be boring on the surface, but produce a large amount of free cash flow. During the tech bubble of the late 90s, Warren Buffett warned that internet companies were doomed to fail and were incredibly overpriced. Same with Dr. Siegel. And in the end, he was right. Paying the wrong price for the right stock, no matter how good its business model, can be a disaster. Here's an example. Cisco Systems, in the peak of the tech bubble, still 24, 25 years later, has still not returned to its record all-time highs by a long shot. Again, Cisco, not a bad company, not a bad business model. However, you pay the wrong price for the right company. Doesn't matter how good it is on paper, and you could be left holding the bag. So what's the wrong price to pay? Well, it's when you pay, I would call it in the 50, 60, 70, 100, 150 times earnings range, where there's just no potential for the discounted cash flows to ever give you an IRR that exceeds the cost of capital. So what we try to do is at least look at the cost of capital and then compare that to earnings growth rates. And if you have a company that can't even grow its profits by, let's say, the rate of inflation, or maybe you want to even go more stringent on your terms and say the 2-year treasury at 5.5%, then you shouldn't buy the company. I mean, we're very careful with this when we run our Stenger quality screens in the portfolio. And again, it's not a guarantee that things are going to work out for you, but at least what it does is it says, here's the companies that have been growing their earnings and profits by maybe 6%, 7%. At least it exceeds the cost of capital. So you ask yourself, why is Berkshire sitting on this war chest of cash? Why is Apple sitting on $185 billion in cash? The answer is because they aren't finding projects that are probably going to exceed the cost of capital. That opportunity cost of leaving a 5.5% treasury and going into a risky project where maybe you're only earning 6, 7, 8%. So that's what you have to do, is look at the earnings growth rates. And then, okay, we've got earnings growth. Maybe a company's trading for 100 times earnings because it's growing 20% a year. Well, guess what? No company grows forever. No company grows 20%, of course, forever. And so that's why the Dow, in my opinion, the Dow Jones Industrial Index, the people that basically vote on what companies go in the Dow. Remember, it's not just a passive index. Same thing with the S&P. It's not a passive index. There's actually a committee of people deciding what goes in and what comes out, and then they rebalance throughout the year. Kicked out ExxonMobil from the Dow in 2020, replaced it with Salesforce. Well, when they bought Salesforce or put Salesforce into the Dow in 2020, it was effectively trading at 1,800 times earnings. Exxon was trading at 7 or 8 forward earnings. And so that's the big mistake. Now you look at the results the past 4 years, Exxon's up like 250%. Salesforce is up about 5 or 6%. Big mistake. So be careful with what you're buying. You have to know what you're investing in. You have to understand the business model, and you can't go wrong buying companies that produce a lot of free cash flow, with one caveat, that they're growing that free cash flow above the rate of the capital cost of capital over the long run. So that's number 2. Number 3, the U.S. is still number 1. And there was a great question that was asked to Buffett at the last annual meeting about investing in international companies. What about all the opportunities in China, Europe, and Japan? Now, Buffett does invest in Japan a little bit, but he did state, and he answered this question by saying that Berkshire's primary investments will always be U.S.-based, United States companies. To which he got a big standing ovation. I don't know if it was standing, but he got a big round of applause for saying that. You have a lot of people in that room who do not want to see Berkshire, do not want to see their investment advisors buying international stocks. Why? Not because there's a bunch of bad companies overseas. Well, there are, but it's because primarily the best investments have been in the U.S. And it's not because these entrepreneurs aren't smart in other countries. It's not because the Chinese or the Japanese or the Europeans can't innovate. But the structure that they've operated in, the structure that they built politically and policy-wise in some of these places, has forced the best Chinese, forced the best Japanese, forced the best Europeans and Africans and Latin Americans to come to the U.S., where we have the rule of law and personal property rights. And so that's why the United States, and you look at the Forbes billionaire list in our country, about 800 billionaires now, most of them are first generation wealth. I don't know if you know that, but most people in the Forbes billionaire list did not inherit the money they have. They built it the old school American dream way. And they came over here, bootstrapped their way to success, came over from a different country, built a life for themselves, followed the rule of law and personal property rights, and this country has made them richer than their wildest dreams. But the most important part is it's enriched the businesses and the people and the companies and the other customers that they interact with much, much, much more. And there's been studies on this where billionaires only reap about 1 or 2% of the final output of the societal good that they create. So we should all want more of what's happening in the US. We should want more capitalism, more freedom, more entrepreneurship. And I'm not talking crony capitalism where government and business work hand in glove to stomp out the competition. And I'm not talking about crony capitalism that comes from both sides of the political aisle that picks winners and losers. I'm talking about true competition where companies do the right thing, they grow. Companies do the wrong thing, they go out of business. If you take care of your customers, you take care of your employees, you do fine over time. If you do the opposite, you literally go to zero. That's true capitalism. So we should want more of that. We should want the government to shrink in size, like I've been saying. We should want the individual to increase in size, the entrepreneur to be a bigger part of the economy, because that's where freedom comes from. Entrepreneurship, business formation, capital chases good ideas, and good ideas flourish in our country because we know at the end of our lives that our money goes to the places that we designated to go to. It's not the government in control, it's the individual in control. That's the secret sauce. That's why the U.S. has flourished. And so when Buffett's asked about international investments, he says it over and over and over. The U.S. is still the best and the last and best hope this world has ever seen. There's a reason why people swim across shark-infested waters from communist countries to arrive at the port of Miami in search of a better life and for freedom. There's a reason why everybody wants to be right here in the U.S. And I know you'll say, Nick, we have our problems. We've got our issues. There's volatility. There's political strife. There's all this unrest. You say, wait a second. Yes, we've got our problems, but we're still the shining hill in the city. We're the best house in a bad neighborhood, and we're the place everyone else wants to be. So stay in the U.S. That's my opinion. Stay in good American companies. I think one of the most impressive final takeaways from Buffett's comments this year is the phenomenon of compound interest over a long period of time. Like Einstein observed, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. In 1965, Berkshire's earnings per share were $9, and its Class A shares were worth $19 a share. Today, its earnings are around $35 billion, and its shares are $608,000 each. Wow. Going from 19 to 608,000 a share. Let's talk about the S&P in that same time frame. Back to 1965, dividends on the S&P 500 have risen from $2.83 to $70.30. Profits have risen from $5.30 to $250. The past nearly 60 years, inflation has gone up 3.9% per year, but earnings on the S&P have gone up 6.8% a year, and dividends have risen 5.6%. If you stayed in cash that entire time and you believed all the doom and gloom stories that the world was coming to an end, you might have put your money into money markets, where the return has been 4.7% per year versus the S&P's total return annualized at 10% per year. Dr. Jeremy Siegel pointed this out in Stocks for the Long Run, that stocks are your best hedge over time because companies are growing their profits. We covered that today. Companies are growing their earnings, and they're distributing those earnings back to you, the shareholder, and that's why your portfolio goes up over time. The price you got to pay for it, the price you have to pay for the 10% and not staying in your cash at 4.7 is simply volatility. It's your ability to stay the course despite the market declines. And if you can't stay the course, what I would encourage you to do is to call a good fiduciary financial advisor who's got your best interest first and is going to do a financial plan for you and put investments together that are on a goals-based plan according to your needs that are going to keep you on a long-term plan over time. And that's the coaching, the consistent advice over the long run that adds value. You're going to have to pay for it. You're going to have to pay maybe 1% or less in fees. But the reality is, over time, that 1% will pay for itself by making sure you don't panic the next time the doom and gloom comes. So that's what we do here on this week's show. That was episode 150. Thank you for being with us. Go watch the episode with Martin Norton. Subscribe on YouTube, Apple, and Spotify. We so appreciate. Hit the subscribe button. Gets the show out to more and more people. We'll see you next time, episode 151. Thanks so much.